Good morning. My grandmother was a history teacher for almost 50 years. Back in 1972, in the middle of her teaching career, she purchased a great life insurance policy as a safety net for the family. When she was retired, the premiums had already become too expensive, and she could no longer afford the yearly payments. Unfortunately, her financial advisor ended up selling her life insurance policy to an investor. Could you imagine? After paying the premiums for 30 years, year after year, she had no choice but to let the asset go. She sold a $1 million policy and received just under $100,000. Just like that, $1 million, a lifetime effort, and the family's safety net, gone. This sale is called a life settlement. It's when a seller receives a check from the investor and the investor becomes the beneficiary of the policy. It's a highly regulated $30 billion market, and it's broken. And my personal story is not unique. It's the story of tens of thousands of families going through this difficult experience of selling or losing a valuable asset they own without receiving what they deserve. But here's the thing. This difficult experience invites massive opportunity for investors, because investors in life settlements are earning double-figure returns in a non-correlated investment. So even when the markets crash, they still profit. And this is why you have Berkshire Hathaway, Apollo, Blackstone, all actively investing billions of dollars into the life settlements market. However, the medium and small investors don't have the opportunity, like hedge funds or family office, cannot benefit from this alternative investment because the barriers to entry are too high. And why is that? Well, buying one policy may be affordable, but that's an undiversified, high-risk, poor investment. A good investment would be many, many policies, but that's just not affordable, and that's exactly the barrier. But what if we could have both? Imagine we could give investors easy access to hundreds of policies where they could choose to purchase many portions. Now that's an affordable, great investment. List is a marketplace for trading portions of life insurance policies, and we make sure that both sides win. So how does this work? An investor logs into the list and can choose how much to invest and how many portions of policies he would like to buy. The money he invests will cover the premium cost and will turn him into a partial owner in pure alpha assets. And his ownership can also easily be resold through List, making his investment even liquid. Bottom line is, now we are allowing investors of all sizes easy access to a highly profitable $30 billion market, while at the same time we're offering seniors, like my grandmother, much more value for their asset. Because now their financial advisor could list their policy on List. And from this moment on, List is trading for them. Just the right portion is sold so premiums are covered. And no more giving up a lifetime effort. My grandmother would have loved List. Our business model is simple. We receive shares as a commission with no additional subscription fees from our customers. We have recently closed a seed round from executives in the insurance industry, and we're now onboarding our first policies. It's not very often we get to redefine the industry borders in a broken, 100-year-old, $30 billion market. But this is exactly what we are doing today. Thank you very much.
Thank you, Yaacov. Okay, 4 minutes of questions. Tomer.
Hi, Tomer from Viola Fintech. So within the business model of carriers, actually lapse rate is an important ingredient, and you're basically sort of like, lowering it very significantly. Wouldn't that cause premiums to be much higher, and as a result, have sort of like a secondary effect that it eventually will screw up your efforts?
Great question. I would divide it to two stages. Stage number one, we're talking about a 100-year-old market, which has been pretty institutional for 20 to 30 years. So it is true that less lapse rate is calculated into the premium cost, but it already exists in an inefficient and unfair manner towards the seniors. So first stage is a big enough big enough business to create just on the existing secondary market, which is already factored in. That has no effect. We believe that if we create efficiency, we could even expand the market beyond the tens of billions of dollar market a year to even more than that. And then yes, it would have a side effect to the model. Insurance companies cannot stop this. The contrary, the regulator is totally for this market because we have a very large lapse rate where people are losing assets and just lapsing them just anyway. 88% of permanent life insurance lapses in the US. Does not reach maturity, does not reach payout. Only 12%. So the regulator wants that 12% to increase. Will it have a side effect on premium cost? Of course. But if we get 1% of a $17 trillion life insurance thing, then it's a big deal. Market.
Hey, David Feldman from Deloitte. Great presentation.
Thank you.
I was wondering what your go-to-market strategy is now that you've recently closed this investment, and a word about who your actual investors are, if possible.
For the platform, for our company?
For your
platform.
For your
okay,
platform,
so go-to-market, our investors, I'll start from, I think, from the end to the beginning, but basically our investors to our platform are accredited and above. So any accredited investor, family office hedge fund, that's the range we're looking for. Similar to many other secondary platforms in the factoring or lending or venture capital, all the other kind of platforms, same sort of investors looking for non-correlated assets. 75% of private money in the US is held by accredited investors looking for alternative investments. So that's our demand side. From the supply side, our go-to-market number on the first stage is the tertiary market, which those are the policies we're working with today. So portfolios of policies which were already bought out by investors who are also sometimes looking for liquidity on the premium so they could buy more and diversify, if that makes sense in 2 seconds. And the second stage is we would like to go direct to consumer or working with brokers. So we have our connections, relationships with brokers which want to onboard policies, but we want to start with some portfolios just for chicken and egg solution. And in terms of direct, we believe that we are giving a much better solution for the seniors where they get basically liquidity on their policy when they're still alive and they could actually live off it. So we think that partnering with AARPs, which we have connections with and so forth of the world, the well-being institutions is the best way to act on this.
Any other questions? Yes, I know.
I know from BBVA. Could you give us the chance to know a little bit more about your team?
Yeah, because of time, I skipped that, sorry. I'm Yaacov. I was 12 years in the Israeli Air Force, and for 6 years I was in the business department, financial modeling, doing financial modeling. So I was working on significant deals with the Israeli Air Force, working with Lockheed Martin, Boeing, Elbit, Rafael, and so forth on finance. And my co-founders, Yaacov and Itzik. So Itzik's the CTO. He was 12 years, he's been coding for 12 years. He taught for 5 years in the Technion Institute, and he has experience of managing large teams in software development and high-tech. And Yaacov, our third co-founder, he has 7 years of product management. He worked for several high-tech companies, and the three of us together as co-founders.
Okay, lovely.